Hello and welcome to Spectrum's Investor Confidence Index webinar for December. I'm Kent McDill, Senior Writer here at Spectrum, and I'm joined by Spectrum Senior Consultant Kathy Dordick. As it is the end of the year, today we are going to discuss the index results for the calendar year 2019. I will discuss the results of the Confidence Index from January to December 2019, and Kathy will discuss the results of the Spectrum Household Outlook over the same period. The results from the 2019 Spectrum Investor Confidence Indices actually started in December of 2018, when the stock market took a frightening dive that included a 4,000-point loss for the Dow Jones Industrial Average. As a result, that month, the Spectrum Millionaire Investor Index sat at 1, and the Spectrum Affluent Investor Confidence Index was at -5. For the Millionaire Index, that was the lowest number for 2018 and the lowest number in almost 3 years. So 2019 was a recovery period for both the stock market and the Spectrum indices. In both cases, there was a swift recovery. However, both the SMICI and the SAICI saw lower numbers again in August of 2019 than they recorded in that December rating from a year previous. This chart indicates the path taken by the Spectrum Investor Confidence Indices this year. As you can see, starting from the left where the top blue line is, which is the SMICI. It recorded a 1 in December, but it swiftly recovered and reached double digits just 2 months later, in February of 2019. In June of 2019, it climbed once again to 13, then fell by 15 points over the next 2 months to dip into negative territory in August. The SAICI followed a similar pattern. The past 3 months have been a recovery period for both indices, with the SMICI up to 8 in December and the SAICI at 1. The SAICI, which commonly runs lower than the SMICI and has fewer large movements, had a range of 13 points over the calendar year, which is pretty large, from the high of 6 in June to the low of -7 in August. What prompted these highs and lows? Let's think about the events from February, June, and August of 2019 to see what was going on in both domestic and international matters that caused investors to react as they did. By the time February rolled around, the Dow Jones Industrial Average had climbed from 21,700 in December back up to above 25,000, where it has remained for the rest of 2019. In February, negotiations with China looked positive once again, an ongoing story throughout the year. And there were new reports that progress was being made on the wall between the United States and Mexico. At the same time, new reports of nuclear weapons increases in North Korea tempered some of the optimism. From this chart, you can see that new interest in stock investing climbed to 30% in February. And those investors not investing, which means the investors who declared no plans to increase their allocations in any investing area, had one of the lowest percentages of the year at 33.6%. From February on, the stock market maintained a slow improvement throughout 2019 and reached record highs on almost a daily basis in November. However, investors were uncertain that the stock market reflected the reality of the economy and the security of the American political outlook, as President Donald Trump began to face inquiries related to his possible impeachment. If you look at the percentages of those not investing through the year, among all investors, that percentage stood at or near 40% the entire year. That is a high percentage of investors who were staying the course rather than participating more in a stock market that was actually rollicking. By June, the stock market had recovered to the point where it was nearing record levels, and Federal Reserve Chairman Jerome Powell suggested that interest rates would drop over the summer if the economy stayed its strong course. New stock investing jumped to its highest level of the year in June at 31.2%, while cash investing, the safest product for investors who want to invest without great risk, dropped to its lowest level of the year at 19.2%. In June, investors believed in what the stock market was selling. 2 months later, though, as you can see in the chart related to the August numbers, investors reversed course. The change came because of interest rate yield on Treasury bills inverted drastically, with the 2-year notes paying off more than the 10-year notes, which is not supposed to happen. This indicated investors were taking a short-term approach to gains in Treasury products rather than the long-term look, and an inverted yield curve historically marked the beginning of a recession. In the middle of the month of August, the Dow Jones fell 800 points amid those recession talks, and the Spectrum indices responded in kind, as additional stock investing fell to just 24.8% among all investors, and cash investing rose to its highest level of the year at 28.8%. What was interesting about the August index, however, was that those not investing in August was relatively low at 37.2%, which indicated investors wanted to take advantage of lower stock prices as the recession fears grew. Of course, the recession did not occur, and since August, there's been a steady climb in both the stock market and in the Spectrum indices. It's interesting to note that while the stock market reached records on a daily basis in November, the Spectrum indices climbed, but not as much as might be expected. The SMICI reached 8, and the SAICI climbed into positive territory at 1, but that was well below the best numbers of the year. As economists tell us all the time, the stock market is not the economy, and individual investors pay attention to more than stock market numbers when they decide whether to add to their investment allotments. In 2019, investors appeared to be more careful than they might be expected to be considering the way the stock market moved. Now, Kathy will discuss the results from the Spectrum Household Outlook, which asks investors to consider 4 components of their household finances to determine how they feel about the economy, how they feel the economy is affecting their household.
Thank you, Kent. The 4 components of the Spectrum Household Outlook are household income, household assets, company health, and the economy. The outlook numbers for the household assets and company health do not change much month over month, but the household income and economy are the points I'm going to discuss today. Here are the total outlook numbers for 2019. As you can see, the outlook started out very low at 10.9 due to the impact of the severely depressed stock market in December. For comparison's sake, the outlook had not been as low as 10.9 since October of 2016, just before the presidential election that occurred that year. Of course, you can see from this chart that the outlook dipped to 8 in August when the talk of recession sent fears through investors at all levels of wealth. The recession, of course, did not occur, but sometimes all it takes is a conversation among economists to send fear through the hearts of investors. This chart actually does a good job of creating a visual sense of the roller coaster investors are on through a calendar year. The heights reached over the summer are in contrast to the deep dive that occurred in August, and 3 months later, the outlook has still not fully recovered, although it is once again above 20 at 22.3 for November. The next slide is looking at the overall outlook. The overall outlook is created when the outlook for individual components is compiled. This chart shows the relationship between investors' outlooks for their household income and the total outlook. You can see that those 2 numbers rise and fall concurrently, and that household income is rated higher than the total outlook, meaning that household assets, company health, and the economy are likely to be drags on the total outlook. The outlook for the economy does not follow the same path as the outlook for household income and has been in negative territory for half the year. The outlook for the economy has been in negative territory overall for 3 of the last 4 months and does not necessarily improve as the household income numbers or the total outlook numbers go higher. This indicates that investors are uncertain whether the success of the economy occurs at the same time as their household income improves. This has been the December edition of Spectrum Index. Thank you for listening.